Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty. I'm a Phoenix area, metro area real estate agent, or actually realtor. As a realtor, we subscribe to a higher code of ethics. And, we'd like to do our weekly market update and kind of keep you what's going on nationally and what is going on here locally. So if you like what you hear, please like this video, share this video, subscribe to our page. We certainly would love to be able to pop up every time there's something new to report on these sort of things. So anyway, let's dive right into the information here. There's a lot of again, a lot of misinformation out there, and I'm going to explain why and how, and what is actually going on right now in the market. So let's dive right in. I'm going to share my screen with you here, and hopefully you can see that okay. So some of the doom and gloom that we'll see um, in the mainstream media, stuff like this. And I'm going to run through these articles pretty quickly, but wholesale prices rose 0.7% in January, more than expected. In other words, fueling inflation, inflation's going higher. And then it goes on to say, that the information on inflation and a jobs report just doesn't seem to be taming inflation, just doesn't seem to be dampening down the rise in cost of things and all that. But and for unemployment. But we knew that, the beginning of the year was going to be a little rocky. We told you that till we, got into, later on in the year. We should see some better data coming up, right around March 10th and 14th right now, because rates went up because of all this news. But in reality, we really lost 2.5 million jobs. Okay. On the business survey, and we only gained 84,000 jobs in the household survey. So these are kind of what fuel these articles. This is what kind of fuels the market. The unemployment rate shouldn't have gone up, not down. But because the seasonal adjustment, which we talked about this the last week or two, we got this information again from MBS Highway, Barry Habib, three-time Crystal Ball Award winner. Again, I'm not an economist. I'm not predicting the future. All I can give you is data points, history, and what happens and how markets work, right? So he's the best because he's typically right unless something comes out of left field. As he always explains, what is likely to happen in the markets, what is going on in reality. He likes to kind of dig into this a little bit further than you're going to get from most of the mainstream media, and that sort of thing. And I'll explain why a little bit more here too. But because of the seasonal adjustment on employment, and the capture on that, and for population control, which happened in early 2022, and those factors that go into the market, that was lumped in with January of 2023 numbers. Plus, there's a slight adjustment for insurance, which is another thing that he talks about. And so the numbers are really fictitious in the idea that they look worse than they are. But when you go deep into it and you understand this stuff and get beyond the headlines, and I think I shared with you a couple of articles on this last week to go in more detail, but I'm not going to rehash that again. But you got to also understand a lot of this stuff is being taken over by computerized trading. So they see these numbers, the computer reacts, and it's not really going deep into all the factors that are kind of lumped together and seasonal stuff or the lumping in of things and what the data points really mean, what the way the economy actually works, and the way, a lot of this stuff is even lagging in what we're looking at. So there's a lot to it. But the next job report, as MBS Highway and Barry Habib explained, should right the ship as far as showing some better numbers. That'll be coming out on March 10th. Okay. That next jobs report. And then on March 14th, we should see more favorable readings, and they'll be getting caught up on all this data basically that we already know exists, and their CPI report on inflation. So we'll start to see things actually adjust back to where they were beyond the past week or so. And we should see the rate. In other words, we should see the interest rates also go lower. Okay. Kind of back to the way we're, or even lower possibly. Again, remember the big date that we've been talking about though is going to be the reports coming out in May 10th, and also going into June. So keep an eye out for that. That's when we're expecting to see, year over year inflation really adjust. All this data and stuff coming out of the seasonal stuff, kind of, getting into what's the reality of the jobs market and all that stuff. And they'll all be playing catch up by then. And we should see a really big drop off. Now, where are rates going to go? Probably from every indication when we're talking about conventional rates on conventional loans, FHA, VA, those are different. Those are government loans, but on conventional, we're going to see probably, again, we're going to see some fluctuation until we get to the middle of the year, until we get to the end of the second quarter, beginning of the third quarter. But we're probably going to be, around 5, possibly into the 4s. Okay. So look for that low 5s, maybe even going into the 4s by the end of the year. Okay. So keep an eye out for that. All right. So one other thing I wanted to point out was, again, this is just more on inflation, blah, blah, blah. The same thing we just kind of went over in general. So I don't want to take too much time on that. One big article that came out from Redfin, some people are talking about out there, is investors are buying roughly half as many homes as they were a year ago. Okay. Well, again, we're not in the same market. We're not in the anomaly market, right? So when we look at the local market here, because this article talks about a lot of different markets around the country, but of course, it goes into the idea that, Phoenix is lumped in here. Okay. Now, some of this is correct and some of it isn't, but the reality of what we have from our multiple listing service and Crawford report, it takes all that information and then, curates it. But in reality, the owner occupied versus investor, when we look back at 2020 to 2022, at the beginning of 2020, of course, during the pandemic, people were like, oh, what's happening? So it was at 8%, where the year, the several years previous to that, or quarters previous to that, be like 13% investors or second homes, type of home buyers being involved. 11 to 12, 13% was kind of the norm going, back several quarters. In the beginning of the pandemic, it was 8%. And then when we got to and then it gradually went up from there. And we got to Q2 of 2021, it was 17%. Okay. And then when we got to Q2 of 2022, we kind of peaked out at 21%, investors, second home buyers, that sort of thing. And then the last couple of quarters, it went down to 18%, then 15%. But remember, it's going down, but it's going back to normal, right? Because again, before the pandemic, before the anomaly years, okay, we had 11, 12, 13%, depending on which quarter you were looking at, before the pandemic. Okay. So being at 15% and gradually probably slipping down more towards that 13, 12, 11% range is normal, guys. It's not Chicken Little, sky's falling. It's not the end of the world, and it's not the crash of the housing market, at least especially here in Phoenix. Okay. So when we look at our weekly market report, we always get into the Crawford Market Index. Okay. Now the Crawford Market Index, I'm just going to take this off of here. Okay. I'm back. Okay. Crawford Market Index is an index from the Crawford people, the people at Crawford, the Crawford report. And basically, anywhere between 90 to 110 is a balanced market on their index. Okay. So 100 being completely balanced. Right now, the overall market in the greater Phoenix area is 124.2. Okay. that means technically we're over 110. So we are in a seller's market, not a crazy anomaly seller's market where, before the last couple of years, before the market shifted, we were in the 400s, high fours and that sort of thing. Now we're at 124. Okay. But that number's been ticking up, creeping up there every week, the last few weeks. And then we hit these higher interest rates with these crazy reports. Okay. That we just talked about. So our demand on the index is at 80, which is, again, would be 20 points lower than 100, right? So that would mean we're 20 points off from that mid-range of balance. But that demand has been driving the market, but we've seen a little bit of a slowing, probably, right? Because the interest rates just went up because of these crazy reports. Again, we should see that. We talked about this. It's going to be rocky till we got to May 10th. We talked about this. Okay. But we should see a little bit of an easing there when we get to March 10th and 14th, like I just talked about. Supply is also another factor because this has been keeping us, from, everybody wants to talk about, oh, we're going to crash. But back during the crash, again, our supply was off the chart. Our supply in the Phoenix area, and when you look at supply across the country, we're actually low in supply. I talk about this all the time. You can go back and look at, we were at 3.8 million nationally. Right now, we're like 1.2 million homes for sale, and a lot of those are already under contract. Okay, household formations are like 1.4. So that means there's not enough homes to go around. Just looking at the conservative numbers. But in the Phoenix area right now, we're we're hovering right around, depending on the day, right around 15,000 homes for sale. Okay, on the MLS. During the crash, we're at 58,000 homes for sale. Nowhere near the supply. Nowhere near the supply, and our demand is still pretty strong, even though we've seen a slowing in the last few days because rates went back up again. Rates on average this past week when they jumped was like 6.8. So we got close to that 7-point range again. But we're already seeing that they're starting to taper off just a little bit and starting to, and again, those are average numbers. I like the deal and I like to, make sure my home buyers had the best options. So I always recommend looking at a broker because they can shop the best rates for you, probably going to have lower terms. With a retail lender, there may be certain little products they may have that could be an advantage, but overall, a broker is going to be able to broker out to many lenders who have many different loan products. And typically, since they're dealing in the wholesale market, they're not spending a fortune on the retail side of, spending for marketing, and their caps are usually going to be a little different too. So in reality, again, it's going to probably be your terms are going to be better with a broker. You're going to have more options and probably lower interest rates in general. Okay. So guys, just something to think about there. And then, so right now we're technically again in the seller's market. And when we look at each city individually, we see again, going from that 90 to 110 on the Crawford market range, we are looking at everything being in a seller's market. Technically, Peoria is at 109, so it's not quite in the seller's market, but then Surprise is at 97, Goodyear at 89, Queen Creek 77. So those let's see, Surprise would actually technically be in a balanced market in Peoria. And then Goodyear would be at 89, technically out of that range of balance. So that would be buyer's market because it's below 90. Below 90 is buyer, above 110 is seller. Queen Creek's at 77. Maricopa's at 65 and Buckeyes at 61. All the other cities are technically in a seller's market. Not a crazy, nutty market like we were in before, but most of the cities have up arrows trending towards seller though, except for Cave Creek has trended down this past week, along with Scottsdale and Paradise Valley, which usually isn't the case with Scottsdale and Cave Creek, but we've been seeing that there this past week. So new accepted contracts. Now, We were up as high as for the week up towards the 2000 range, but this week we're at 1822. So a little bit of a dip there, but again, nothing crazy off the mark. But in the interest rates would definitely be the issue there. And we should see that pop right back up as soon as maybe there's more inventory and lower interest rates coming in the next over the next couple of months. Again, things will kind of be a little rocky, but in March, we should see a little bit of an easing going into the March 10th date. May 10th, though, that's going to be the biggie. Okay. We should see things really drop off then. And as far as our active listings from Crawford report, active listings and weekly counts compared by year, we see that we're again, very low in inventory than where we have been over, the shift that took place, because we were up near, 18,000 homes for sale when that shift took place, like back last April, May, we were up, we had quite a few more homes on the market. So, nothing really crazy there. That low supply has actually been keeping things moving along, in the sense that we haven't had an overabundance of inventory, which can cause issues at that point for sure, but we just haven't seen that. Now, this is a really good indicator here from the Crawford report. Listing success rates, this is a very good indicator. Now, of course, during the years of 2020 through 2022, they were up over 80, even up around 90%. Okay. But this time again, right now, same time this year, we're at 72.4%. Crawford says anything over 70% is good. Okay. So that's a good indicator that we're in a kind of a normal market. Again, guys, we just shifted to normal. That's all that's happened. We just shifted to a normal market for the Phoenix area anyway. And I think for most places across the country, for that matter, but listing successes have really, they're actually better than they were towards the end of last year. But again, nowhere near those anomaly, crazy, frenetic years that we saw. So listing success rates, when we go back, if we look back, like say to other balanced market years, overall years at 2020, 2014, 2015, for instance, we're right around the same level as far as listing successes. So we're in a normal balanced market. That's all that's happened in the corrections that have taken place. Nothing nutty. So I'm going to read to you, what the Crawford report has basically said, word for word here. So it maybe makes a little bit more sense. They said the result of all this is that the market will see balance. Okay. Moving in favor of sellers, which will help support pricing, volume of transactions, and will not rise as quickly as it would have if rates stayed as low as January. Okay. As low as they were in January. We are seeing an increased closed transaction rate, as you would expect for this time of year, because we're going into the busy season, right? We're heading into tax season. People get their tax returns. We're heading into getting close to when school lets out. So people are really starting to think, I need to sell my house. I need to move on. I need to get my property under contract so I can move when school lets out, or right around when school lets out during a busy time of year, get moved and done, ready for the next activity year, next school year. Okay. So we're seeing an increased closed transaction rate, as you'd expect for this time of year. This listing success rate has also recovered, and now it stands over 70%, consistent with a healthy market, which we just talked about. So basically, the correction in pricing has run its course, and we are now back to a normal market, far less frenetic than we experienced between 2020 and 2022. Okay. So guys, that pretty much summarizes everything that's going on in the housing market right now. We are truly back to balance. I think that's kind of, and a lot of people, loan officers haven't been doing, as much business. Realtors haven't been doing as much business. I think what you're going to see is you are going to see a lot of people maybe get out of the business. A lot of people are waiting to sell and buy because of the rates, because there's not as much in the way of options maybe. But I tell you what, whether it be a new or resale home right now, you could save yourself as much as, 30, 40, even $50,000 with some of the adjustments that have happened. And you can still do 3-2-1 buy downs, 2-1 buy downs on the rates. The seller actually pays for that in the closing costs or concessions. Okay. And what that means for you is while we're waiting for these rates to go down, get the good price on the home now, or you could get the price on the good home on it right now. Let me put it this way. If interest rates are going to go down, when do you think they're going to go down? From everything we know, year over year inflation is, in reality, and if the jobs market in reality, as we talked about, is what we're explaining that it is, then when do you think rates will come down? And what's going to happen when rates do come down in the end of Q2, beginning of Q3? Well, yeah, there's going to be even more demand, and there'll be people putting their house on the market, but a lot of those people are also going to be buying, right? So, and the builders they're not going crazy in building houses. They're not going to do what they did in 2008 and overbuild, which led to poor lending practices back then, to unload the inventory or try to unload the inventory, and which led to all the foreclosures or people owning homes they shouldn't have owned. So what do you think is going to happen? Well, prices, when demand goes up, prices will naturally go up as rates come down and inflation comes down. Inflation drives mortgage rates. So inflation comes down, rates come down. What do you think is going to happen? There's going to be more people in the market. There's going to be more people that can afford a home. If rates go down 1%, we talked about this last week. Yeah, it's terrible if we have 1% more unemployment, which means 1.5 million people that are in the workforce are probably going to lose their jobs. Okay, overall, if we figure about 1%, and we certainly have empathy toward that, and not saying everything's hunky-dory in the market as far as affordability, but if interest rates go down 1%, that means 5 million people can now get into the market, can now afford a home because of those lower rates. They can afford that payment, and they'll move if they need to, if the options are out there. So as more people go to sell their homes, the options will be out there. As builders see that there's an increase in demand, they'll start ramping up a little bit more. So when demand goes up, what do you think is going to happen? Prices are going to start to go up. So right now, if you bought a home in February, you go under contract, say you close in March, you're not going to have your first payment, if you close in March, you've got April, you're not going to have your first payment until May 1st. Okay. You get into a 3-2-1 or a 2-1 buy down, your rates could be as low as around 2 to 3%. Okay, depending on all the factors. Okay, again, using round numbers again, and a loan officer will go in more detail with that to you. But you can then, when the rates do drop to a normal fixed rate that you want, you can then refinance out of it. You know what the great thing is about those 3-2-1 or 2-1 buy downs? You can actually take what the seller paid for in your escrow account, still sitting there, and transfer it to your refinance. And refinance, there's no out-of-pocket cost to you to refinance. And now you can get a low fixed rate, because the 3-2-1 or 2-1 buy down, the first, year, 2 years, those are going to be great rates. But then when you get into the third year, they're going to be up probably around to where, things a little bit lower, or around where things are right now. So you can get out of those, but roll that escrow, the money sitting in the escrow account, over. So it actually costs you nothing because the seller paid for it. Okay. So guys, reach out to us. What would be the best way to go on this? I'm just saying, you know, like here are the data points. Here's what's happening. Here's the reality of where we're headed, where we are. And, you know, it may make sense. If it makes sense and you can afford it, it may make sense to get the great, fantastic price on a home now. Okay. And then, you know, and get the low rate with those programs, and then get the low fixed rate, you know, after you know, the rates have dropped, and you remember, you go a couple months, gives you a little bit more time without having to, you know, worry about the payment and all that. Get that lower rate and move on. So it just an idea there. Okay. And you always want to be ahead of the curve before everybody else gets there, right? I'll tell you what's going to happen, you know, right around when these rates drop, everybody's going to flood into the market. We had the same idea. Everybody's going to have the same idea. Okay. So if you need more information, guys, reach out to us. We'd love to be able to talk to you about, you know, what we could sell your home for, how we could help you save money on that, make money on that, save money on a home purchase now versus waiting, and what that would look like a little bit more in detail with one of our loan officers. And, you know, again, you can always reach us at 480-788-8569. Check us out at home@mincolagroup.com if you want to email us, or mincolahomes.com, mincolagroup.com. And guys, we'll see you next time. Thanks a lot.